When looking at the markets right now, Keel Infrastructure Corp is trading live at $3.88 per share on the Nasdaq, marking an intraday movement down from its opening price of $4.01. At first glance, seeing a prominent infrastructure play slide during the session might tempt casual observers to write it off as just another volatile small-cap casualty caught in the crosshairs of broader tech sector corrections. Yet that surface-level narrative completely misses the structural transformation happening beneath the hood of this exact enterprise. While standard market commentary focuses on short-term ticker friction, the reality is that Keel sits on a massive, highly sought-after pipeline of 2.2 gigawatts with pre-secured grid interconnections, positioning it miles ahead of competitors who are still begging local utilities for power allocations. Most retail participants assume that building out artificial intelligence data centers is merely a matter of securing enough high-end graphics cards, ignoring the brutal bottleneck of electrical power availability. When you evaluate how power grids in regions like Pennsylvania, Washington State, and Quebec actually operate, you realize that owning brownfield and greenfield sites with active grid access is the ultimate moat. This exact friction point creates a fascinating tension between what the public expects from a traditional digital infrastructure name and what institutional players are quietly positioning for behind closed doors. To really understand where this company is heading, we have to look past the intraday noise and examine the underlying mechanics of modern high-performance computing demand. The conventional wisdom floating around online forums and various trading platforms suggests that companies transitioning into artificial intelligence hosting are taking massive, uncalculated gambles with shareholder capital, building speculative server farms that might sit empty if tech giants alter their capital expenditure budgets. People treat power capacity like an endless commodity that can be spun up overnight with a checkbook. But if you talk to seasoned energy grid operators or individuals who manage large portfolios through services like Schwab Intelligent Portfolios, the reality is starkly different. Power is the single scarcest commodity in the technology landscape today. Major cloud providers are desperate for reliable megawatt allocations equipped with liquid cooling capabilities and direct proximity to transmission lines. Keel did not just stumble into this position by accident. By strategically acquiring and retrofitting assets across strategic power markets, the enterprise engineered a pipeline that solves the exact operational headache keeping tech executives awake at night. When individual investors look for opportunities using tools like Fidelity, or when they set up automated asset allocation through platforms like SoFi, they often overlook these foundational layers of the digital economy, focusing instead on software application layers that depend entirely on the physical infrastructure Keel provides. The recent trading volumes and price fluctuations tell a story of institutional repositioning rather than fundamental weakness. Throughout the morning sessions, block trades have consistently shown steady accumulation by institutional accounts that recognize the long-term value of secured megawatts over quarterly earnings volatility. While retail traders staring at mobile screens on Robinhood or tracking fractional shares via interactive brokers' trading apps might panic over a 12-cent downward tick during a broader market pullback, professional allocators understand that multi-year energy contracts do not move in sync with daily sentiment. The company's strategic pivot towards high-performance computing and artificial intelligence workloads means that revenue streams are shifting away from the erratic profitability of traditional crypto hashing operations towards stable, long-term enterprise leasing agreements. This transition requires significant upfront capital expenditure, which naturally depresses short-term margins and spooks unsophisticated market participants who rely solely on trailing PE ratios. However, anyone utilizing a robust online investment strategy or managing their retirement accounts through Fidelity IRAs knows that infrastructure assets operate on a completely different timeline. You're not buying a retail storefront that can pivot its inventory next week. You're buying industrial-scale power generation and real estate assets that take years to replicate. Comment below how many shares of Keel Infrastructure Corp you currently hold in your portfolio. Tracing the historical roots of the enterprise reveals just how intentional this evolution has been. Originally operating under a different corporate identity before executing a comprehensive North American redomiciliation and strategic rebrand, the organization spent years quietly assembling a geographically diverse portfolio of power assets. Operating across high-demand power markets in Pennsylvania, Washington, and Quebec allowed the group to leverage cheap, reliable hydroelectric power in Canada, alongside strategically vital fossil and mixed fuel grid connections in the United States. While past reports heavily emphasized its exposure to digital currency validation, a sector known for violent boom and bust cycles, the current management team has aggressively pivoted the core business model towards serving enterprise artificial intelligence tenants and high-performance computing clients who demand uninterrupted, high-density power delivery. This fundamentally alters the risk profile of the stock, transforming it from a pure crypto proxy into a hard asset energy and digital infrastructure play. Competitors trying to build similar data center campuses from scratch face staggering delays, environmental roadblocks, and multi-year interconnection queues that make organic expansion nearly impossible in the short term. By already owning the real estate, the transformers, and the grid ties, Keel possesses an irreplaceable asset base that cannot be easily duplicated by new market entrants. Looking toward the future outlook, the primary catalysts for the stock will depend heavily on the announcement of major enterprise tenant leases and the continued build-out of its remaining gigawatt pipeline. If management successfully converts its extensive power capacity into long-term, fixed-rate hosting contracts with Tier 1 cloud providers or artificial intelligence labs, the cash flow visibility will completely reshape how Wall Street values the enterprise. Of course, risks remain prominent, including regulatory shifts surrounding energy consumption, potential delays in transformer procurement, and broader macroeconomic interest rate pressures that increase the cost of capital for capital-intensive infrastructure projects. Yet the core thesis rests on a simple, inescapable reality. The demand for specialized computing infrastructure is accelerating at a historic pace, while the supply of ready-to-power land is shrinking rapidly. The expectation that this stock is merely tethered to short-term crypto sentiment collapses under the weight of its actual physical assets and grid positioning. By bridging the gap between heavy energy generation and cutting-edge digital workloads, Keel stands firmly at the center of the most critical bottleneck in modern technology development, offering a compelling proposition for anyone focused on the structural foundations of the digital economy rather than fleeting market noise.